Gold and silver both beat Nifty 50 by 5% in the last 10 years. Shocking, right? But even more shocking is that these stellar returns for silver and gold came majorly in the last 1 year. Silver became 2.6x and gold became 1.7x in just 1 year. So the real question isn't, should I invest in gold or silver now? The real question is, can you capture those returns without overpaying for these assets, without increasing portfolio stress, and without making emotional allocation mistakes? In this video, I'll break down why gold and silver outperformed equity over the last decade, how volatile and uneven those returns actually were, and how smart investors can take exposure to these assets without complicating their portfolio. By the end, you'll have one clear framework to decide what truly fits your portfolio. I'm CA Vamika, and my mission is to bring you clear, actionable frameworks so that you can take long-term investing decisions with clarity and confidence. Let me show you something that will change how you think about gold and silver. If you look at the 10-year CAGR up to 2025, gold and silver beat Nifty 50 by 5%. But here's the twist. If you look at 10-year CAGR up to 2023, just 2 years ago, the narrative completely flipped. Nifty 50 was beating gold and silver by 6%. So what changed? The entire decade's outperformance of gold and silver came majorly in the last 12 months. This tells us something critical. Gold and silver don't compound steadily. They spike violently and then go dormant for years. And that changes everything about how you should own them. But what were the reasons for this insane rally? Three major forces collided at once. First is US Fed rate cuts. The Federal Reserve cut rates 3 times in 2025, dropping the overall rate by 0.7 percentage. When interest rates fall, liquidity in the financial system increases and bonds become relatively less attractive compared to real assets. At the same time, central banks usually cut rates during periods of economic slowdown or rising uncertainty. And those exact periods often see higher stock market volatility and stronger demand for safe haven assets like gold or silver. Second is expectation of industrial demand. Today's silver rally is not driven by current supply shortage. If you see this data released by the Silver Institute, the gap between demand and supply has actually been reducing. Demand gap versus supply has reduced from 24% in 2022 to 11% in 2025. What's driving prices is future demand spike from solar, EV, and electronics. Lastly, but most importantly, global uncertainty, either economic or political. Whenever there's panic in the world, like war threats or economic shocks, investors again rush to safe haven assets. This further drives up their prices. So here's the key insight. Gold and silver rally when liquidity rises and fear rises together. That combination is rare and impossible to predict consistently. In fact, there was a spillover effect after gold rally which led to prices of other metals also rising. Gold and silver didn't outperform because they are consistently better assets. They outperformed because a few unpredictable years did all the heavy lifting. And everyone now wants to invest in these assets because there is a strong recency bias and fear of missing out. But could anyone have predicted this rally? Maybe experts saw Fed rate cuts coming. But geopolitical shocks, wars, macros changing, those are impossible to time. And here's the reality. Gold and silver spike only during unpredictable crises, then go flat for years. In the last 20 years, silver gave negative returns in 10 of those years. More shocking is that from 2011 to 2020, silver oscillated between 56,000 to 63,000 per kg. That is 1.22% CAGR in 9 years. That is why buy and hold doesn't always work for commodity assets. So here's the real dilemma investors face. If you try to time gold and silver, you will almost always enter late. But if you ignore them completely, you miss the very years that drive long term returns. So, how do you get exposure to gold and silver without trying to predict crisis? This is where most investors turn to multi asset funds. But do they actually solve the problem? Let's look at the data. Multi asset funds are mutual funds that invest across at least three asset classes, typically equity, debt, commodities like gold or silver, and sometimes international equity. By SEBI rules, they must allocate at least 10% to each asset class. The idea is diversification. When equity falls, gold rises. When gold stalls, equity compounds. The fund manager rebalances between asset classes based on valuations and their judgment. If we compare returns over the last 1, 3, and 5 years, multi asset funds have generally matched or outperformed flexi cap funds. You would rightly say that it is because of the performance of gold and silver in the last 1 year. But let's look at years when gold and silver weren't really performing. In those years, multi asset funds performed well because of their equity allocation that balanced the fall of gold and silver. But because gold and silver underperformed, multi asset returns were lower than flexi and multi cap in these years. So, multi-asset funds can be an addition to your current flexi or multi-cap funds because flexi and multi-cap funds capture the upside during bull markets, and multi-asset funds on the other hand can give you downside protection during bear markets. From a standard deviation point of view, meaning how much do the returns fluctuate from its average, multi-asset allocation funds have the lowest deviation compared to flexi and multi-cap funds. Expense ratio is also 0.6 to 0.7%, which is in line with flexi and multi-cap funds. But you need to pick a fund that allocates between equity, debt, and commodity based on your requirements, and the fund investing strategy aligns with your investing philosophy too. Okay, so the pros of investing in multi-asset allocation fund. First is exposure to equity, debt, gold, and silver from just one fund. Second is automatic rebalancing by the fund manager based on which asset is undervalued or overvalued. So times like this, when you want to take exposure in certain assets but would want a fund manager to time and allocate, multi-asset allocation fund can be a good option. Third is lower emotional decision making from the investor's side. And lastly, tax advantage in a multi-asset allocation fund. When the fund manager rebalances between equity, debt, gold, or silver, that happens inside the fund. As an investor, you do not pay any tax at that time. Tax is triggered only when you redeem your mutual fund units, not every time the fund manager buys or sells assets internally. Cons are, first, you need to rely on the judgment of the fund manager to time better. So, allocation percentage and timing is extremely dependent on the fund manager's judgment. Second, there could be an overlap with your existing flexi or multi-cap portfolio. Lastly, if this is one of the funds within your overall portfolio, you should see how much is finally getting allocated to gold, silver, commodities as a percentage of your overall portfolio. Example, if this fund is 20% of your overall portfolio and the multi-asset fund holds 5% in gold, then your allocation to gold overall is only 1%. So you must look at your portfolio level allocation, not just the fund's allocation strategy. Let's look at the pros and cons of investing directly in gold and silver through ETFs yourself. First is complete allocation flexibility and timing control. Second is you can manage gold and silver allocation as a percentage of your overall portfolio directly. So you get clear allocation visibility. Example, if you want to keep commodities 10% of your overall portfolio, you can ensure that by directly investing in ETFs and not doing the math like we did for multi-asset funds to find out the share as a percentage of your overall portfolio. But the cons are, first, there will be higher volatility when investing directly in gold or silver. Second, there is a risk that your timing to invest and exit could be wrong and hence you end up making less returns from these assets. Third, you would have to pay tax each time you redeem your ETFs or rebalance your overall portfolio. Hence, this approach would require manual intervention and it is not hands off like investing in a fund. So, which option suits you based on your investing requirements? If you want simplicity and are confused how much to allocate and when, multi asset funds could reduce decision stress, but only if the strategy aligns with your investing philosophy. If you want control and can time entry and exit, ETFs can work better for you if you can handle flat years without panic and not invest at all time highs. There is no perfect product here. There is only the product that matches your investing behavior and requirements. If this video helped you think more clearly about gold and silver allocation, and more importantly, helped you avoid chasing a 2.6x rally due to FOMO, then do hit like, share it with fellow investors who might be confused right now. If you want to know the practical ways to invest in gold, then do check out this video next. Also, do subscribe to the channel to not miss upcoming videos on actionable investing frameworks for long-term investors. Thank you for watching. See you in the next one.